Zerodha is one of the biggest names in the Indian stock market. And if you've been paying attention to the news, you already know how big they've become. In fact, Zerodha, Grow, Upstocks and Angel Broking, these are the guys who've shaped the Indian online trading ecosystem. But what happens when Robinhood, which is a major player in the US, wants to enter the Indian market? That is the hypothetical case that we will explore today. To really answer this, we've set up a mock interview wherein we've gotten a fintech growth expert to solve this problem live. They've had no preparation, they're seeing the problem statement for the first time, and you will see their raw decision making step by step as they come up with a strategy to help Robinhood break into the Indian market. My name is Abhinav, and here's my co-host Manvi. We've spent about 20 years working in growth and marketing. Today, we've brought to you a fintech growth leader so that you can get a peek into their brains as they solve a problem they've never seen before. By the end of this video, you'll have a clear picture of how growth leaders like these approach problem statements at their level. Now sit tight and let the case begin.
So this is a hypothetical case. Indian stock market is brimming with players. There is Zerodha, there is Angel Broking, Upstocks, PhonePe is launching their new platform. Amidst all this, Robinhood, there's a news piece that Robinhood is coming to India, and you were interviewing for their founding brand head role. So what's happening is Robinhood was planning to get a new wedge into the market that we will realistically offer zero commission trading, which some of our players have done in the past, and now they've evolved. But this news had spread. The competitors anticipate Robinhood's entry, and they've all gone commission free for the next foreseeable future, at least 12 months. What alternate wedge, what alternate entry play can you think of for Robinhood coming into India?
If you ask me upfront, it does not matter to the consumer in current state. Let me share why. At the end of the day, the cost of executing a trade, the more cost is actually borne due to taxes. And a consumer actually doesn't mind a 10 rupee or a 20 rupee on an order, because majority of the cost, again as I said, is actually going as taxes to the government. So if you ask me, the consumer is not sensitive about that 10 rupee or a 20 rupee and making it down to zero for the consumer. We'll come to the point wherein it matters. But if you ask about an investor consumer persona, that cost actually doesn't matter. I would genuinely want to talk about the brand wedge that Robinhood should play in. Money is such a beautiful thing that everyone in this world is, even if their careers are trying to hustle, they're all trying to grow their wealth. But the players, unfortunately, don't talk to them in that manner. So we'll come to that facet later. But due to these, I think it actually makes a great sense to have a brand wedge rather than having a consumer product play or any fee play or a pricing play out there. If I were to take now the benefit of Robinhood being established out there in the market, I would actually use the story of Robinhood, how it started and how it has captured the hearts of the people globally while launching in India. A story of two guys who initially built a trading software out there for hedge funds, and then they realized that the cost of placing a trade is almost zero, while people were charged high commissions back then, and they then launched this zero commissions platform. But I would go with empowering consumer to give them tools by the virtue of Robinhood to make those right money decisions, to grow their wealth, to achieve financial freedom. And that would be my entry wedge in India, with such bold statement coming out of a trading or an investment player, which is talking beyond placing that right trade or talking about its features, but talking about your ultimate financial freedom.
You figured out two sort of strengths or leverages to play on. One is the global story of Robinhood. My concern there is that's an Angrezi story. It's an Angrez's story. Will that still play? Because different market, different demands, different wealth status, different everything, different ways about thinking about money. So are you going to literally play a white man's investing journey? Second, you're talking about no other investment platform that's positioning themselves as a financial wellness platform or a financial freedom platform.
So the only gap I was trying to realize is that once you're trying to grow your wealth, everyone is trying to talk about the features that it offers, and also offers your motivation of growing your wealth. But at the end of the day, the outcome is either two-way. You want to grow wealth so that you can be calm in the end. That calmness by growing wealth only comes when you have got a tangible outcome of financial freedom at your end. I'm saying that outcome is desired by everyone. So why not talk about the outcome and the process together? Somewhere I feel that the brands are playing only a way of letting you know that I let you invest in the market and hence grow your money. I would say everyone is growing money with an outcome in the mind. No one is talking to them in terms of either the outcome or the real fear that comes along the path of investing. As I'm saying, it is not about the issue is not about playing your first order. As I said, the issue is about when the stakes go higher, how does someone ensure you that you are on the right path of growing your money to have the tangible outcome of financial freedom that you want. That is what I'm saying, is platforms are not catering to that path very well in terms of tools and products. So while Robinhood has offered that products and tools specifically outside, because they realized that after making investing accessible, the issue did not lie there. The issue was how do you help them achieve a tangible path and to the end outcome. That is what missing as a tool in the Indian market. That is what they offer. The differentiation needs to happen at a product level, and the brand differentiation needs to be taken care of together. As I talked about the brand differentiation, product differentiation also needs to come in. Right now, offering a platform in India which lets you invest in a couple of minutes is not the thing. And Robinhood did back there in the US markets out there. And fortunately, in Indian market, there were similar players who could do that. So we cannot rely on the same product differentiation while launching in India. While I talked about the brand differentiation, again, but due to our experience in US markets, Robinhood has launched a couple of interesting products which left you do passive investing, for example, in ETFs. In India, that market is growing and no one is actually standing for letting you passively invest in the markets via ETFs. So I'm saying an entire positioning around, can I let you passively invest in Indian market? For example, can I place a rule for you that every time you place an order on Swiggy or Zomato, you invest in Nifty 50? That in itself as a play has not been done by a Indian broker to let you start investing. When you start investing,
Going to gold.
it can be done in gold. It can
No,
be
but
done
that's
in
already happening, no?
It's already happening.
Great. That's what I'm saying. So someone is occupying that positioning in your mind for gold. I'm saying, why not for markets? Why not for markets? It's the same product. In fact, it's a product with higher returns than gold out there. So if a spend-linked investing is happening in gold, why not happen in other alternate products? And specifically ETFs, for which Robinhoods have been known to let every American invest in ETFs. So if I were to package the product which has years of stability and the confidence of investors worldwide is now launching in India, letting you passively invest in Indian growth story, that in itself will make me a wedge to enter India.
Got it. Okay. So localizing the story, but no more two white men story.
You view a foreign brand story in India, they will focus on localizing the story. You view an Indian brand story in India, they will focus on westernizing the story. That playbook still plays in India. I think fortunately, when a global trading play will launch in India, that story will go by them, considering more because no one has launched in India. Because the market was much smaller. Now the market is growing. And with Robinhood launching, I think it's a perfect brand and a product wedge to launch in India.
Okay, super. Now what's happened is they expected the Indian team to sort of, take over and be experienced in Indian market. But again, plans are not turning into reality. There's no predictable trajectory that's actually, meeting the profitability targets. There's a lot of burn happening. And the sort of appetite for Robinhood US was about 2 years. You're already, 10-ish months, a year down the line. That's not meeting. You're not able to competitively fight out the competitors. Your commission-free thing is, like you said, wasn't the pain point, was initially planned to be the differentiator, is not playing out that way. One, is there anything else that you would launch as a side product or within the product or something else that you think is an immediate, need to solve that would get you that market share and that would get you sustainability of your users? And second is, how do you craft this initiative to Robinhood US? The difficulties, the cultural misalignment and all that.
I lay out why would have it happened. For example, if today is this situation, why would it have happened? And then I'll talk about the due course of action. So there can be multiple reasons for the current scenario. The cost of acquisition is way high. was very high. Again, a very cluttered market. You're going digital. There are 10 players going digital, acquiring the same user. The cost of acquisition were way too high. Second, folding.
That's always the biggest burn.
Second is something that you wanted to launch in terms of monetizing the user around.
We also hoped that some switching will happen. That's not happening.
So also you hope that certain monetizable product will launch. For example, there is while you are doing a broking play, you're also offering other products in terms of lending, fixed income products, where you have definite margins. But something or the other got delayed in terms of getting launched after launching the initial broking platforms. So one of your monetizable products could not get launched on time. Your costs were too high to acquire the user initially, and hence everything doesn't seem to go with respect to the 2-year view that they had expected from you. But having said that, I think by the 6th or the 7th month, we would have actually tackled the situation in terms of viewing our cohorts. So when I'm talking the 10th month, I may have a perspective that my cohort acquired till 6th month were at a high cost, and since the monetizable product was not launched, the profitability doesn't look good. But maybe you have a perspective of after the 6th or the 7th month, the cohort that you have been acquiring is at X cost, and since the product which was delayed earlier has been now launched, the cross-sell numbers look like this. So the payback period for the cohort after 6th or 7th month looks like this, which helps you to build a case in front of the board that while the initially profitability was aimed at 2 years, for this acquired cohort, it still stays at 2 years. But for the initially acquired cohort, it gets pushed to 2.5 to 3 years. So that will be one of the scenarios that you would want to relay with the board if that's the case.
Understood.
Second, if that's still not the case, how do you go about expediting other products that were supposed to be launched in due time to monetize the user?
So this was a comms to the upper management sort of a question. If I could get a framework for this, you're justifying the past, you are showing, brighter future, and you are showing various options. Is there a framework in your mind when you do comms like this?
Yeah. So the first framework is very straightforward. Your profitability in 2 years depends upon your cost and the overall revenue. The framework here is to show that how the cost has gone down with cohorts acquired later, and how the payback period for them are much better than the earlier acquired cohort. So it's purely a mathematical framework that you show to them, that how the things are now in the order vis-a-vis the expectations out there, which gives them the confidence.
Because
you have a proof of concept of the later acquired cohort. So that's a very straightforward framework. Second one is that wherein you pick from the markets how are the cross-sells for a monetizable product that you are now anticipating to launch earlier than the expected timeline, to fill in for the payback periods for the cohorts acquired for now. I think for that, the framework is again picking how the cross-sell looks on other similar platforms, what are the margins, what are the cost structures going from here. So I think either of these frameworks need to be well shared with the board, well in time, and then there has to be check-ins around it. Because mostly what I have believed is that whenever you're trying to pivot in terms of your product roadmap or business roadmap, the only pitfall that you have is that you're not having your regular check-ins with respect to the expectations. The pivot happens in 9 months. The 12th month check-in doesn't look as per the pivot.
So no surprises.
So no surprises is something that you have to give confidence to the board, wherein I think by now in 9th or 10th month, you get a fair idea that whether a fixed income product or a lending product or a margin financing product or something or an insurance play which can be cross-sold to the users will make more sense to the users. The user research backing that expedition of that cross-sell product, along with the numbers of how the payback period still might look, even if the cost of acquisition for the later cohorts is higher, that needs to be very well given in transparent visibility to the board.
Okay, super. Okay, lovely.
We're done. Thank you so much.